Happy Friday, everyone. Welcome to our live Q&A session on the Paycheck Protection Program. Thank you for being flexible and joining us on a different day of the week as we had to move some things around. If you're joining us for the first time, we do these twice a week on Tuesdays and Thursdays at 1 Eastern to offer up an opportunity to discuss any updates to the program, as there tend to be quite a few over any given period of time, and offer you an opportunity to talk to some of our internal experts here at Fundera about the Paycheck Protection Program. Right now, the main topic that seems to be on everybody's mind is forgiveness, which is where we have tended to focus the conversations, but you are able to ask questions about anything. Before we jump in, I do want to take a moment to remind everyone that we are also kicking off a new webinar series that started this week. The focus is on other SBA products, specifically the 7A loan, which is a wonderful product for small businesses. And if it's something that you're interested in, we will follow up with more information on that after this webinar. So with that, I'm going to hand it over to Justin Ridgely, our Senior Director of Finance at Fundera. He's going to talk a little bit about updates to the program this week.
Thanks, Meredith. Let me just jump to the slide here and then I'll get started. Okay. So in the past week, there haven't been any official updates to the PPP program. Previously we had some updates in these webinars on, the SBA put out the forgiveness application and then they released another interim final rule giving further instructions on forgiveness. But there hasn't been any update from the SBA, but there has been significant progress in Congress towards amending the PPP legislation, the CARES Act, to make some noteworthy changes. So yesterday the House passed, I think 417 to 1, or I might be misquoting that, the PPP Flexibility Act of 2020, which makes a few notable changes to the PPP program and wasn't a wholly new bill, but was basically amends previous bill. In that bill that was passed by the House, it lengthened the covered period duration from 8 to 24 weeks, lowered the payroll threshold necessary for full forgiveness to 60%, and made 40%, the remaining 40% of eligible for non-payroll expenses. The June 30th safe harbor date was also changed to December 31st. And then any payments of principal or interest are pushed back at a minimum until the forgiveness decision by the lender is made and received by the borrower. So essentially, this would be a game changer for small businesses. It would give them more time to put these funds to work. It would allow them to get more non-payroll expenses forgiven, and it would allow more time to meet that safe harbor of June 30th, where you have to get to rehire or restore employee count or pay. So pretty big deal here, and suffice to say, this would be alleviate a lot of concerns people have voiced in this webinar and generally about how to deploy these funds effectively and quickly. And so this was a great step forward, and it was nice to see it pass with a near unanimous vote. However, the Senate still is not in session this week, and they will be back next week to discuss this bill. There was an initial thought that maybe they would just pass this amendment to the previous bill outright, and this would just pass as is. However, we heard from Senator Marco Rubio, who's the chairman of the Senate Small Business Committee yesterday, and he had a couple concerns that at first read seemed somewhat valid. The 60-40 provision, the way it was worded, he basically said, okay, this is great, but it seems to, if you could interpret it in the way that you have to get to 60% to get any money forgiven instead of just achieve full forgiveness. So he was worried, if you got to 59%, whereas today you would still be able to get a large amount of your loan forgiven, he was worried that it would be interpreted where if you got to say 59% in this new regime, you would actually get zero forgiven, which is significantly more punitive than it works now. So it seems like a minor point, should be able to get worked out, we hope. The other point was more vague, and this one, we'll see how this actually works. But essentially, one of the things that was added in this new bill was this 6/30 date pushed back to 12/31. And there was a provision added that basically said, if you aren't able to operate at your previous business levels due to, guidelines from the CDC or other health organizations, then potentially that would give you a safe harbor as well. Essentially, an example of this would be a restaurant that can only seat 50% capacity and therefore might need 50% less workers to staff that restaurant. And so, in that case, you could see kind of this being interpreted to actually be kind of an out to reduce headcount. So his concern, along with I think some union concerns that were voiced previously, is that this would kind of weaken the goal of the Paycheck Protection Program, which is to keep employees hired and paychecks flowing to them. So we'll see where this ends up next week. But the fact that it passed the House and is kind of in the Senate hands, and there has been broad bipartisan support. Hopefully this will get done next week, make it to the president's desk, and then this can be made official. So with that, that's really the, like I said, there's no official SBA update, so I'm going to just go straight into Q&A and try to answer as much as I can during this session. So Meredith, back to you.
Great. Thank you, Justin. Just a reminder for everyone, we have been doing something different over the past couple of weeks where we have been taking questions beforehand, which just gives us a bit of time to prepare to make sure we can give you the best answer possible. Still feel free to submit questions over the Q&A. We do keep a tally of those and include them in our database if we're not able to get to them. But if you are going to be joining us for future sessions, also keep an eye out on where you can submit questions beforehand. So to jump in, Justin, this is a popular question we get, and it's worth visiting again, which is, if you're a sole proprietor, do you know if you can use your home office cost towards rent in terms of forgiveness eligibility? Justin, you may still be on mute.
Yeah, sorry about that. So the way I've answered this before is that, there hasn't been specific guidelines, issued about home offices. However, if you're someone that is a sole prop and, expenses this as part of your Schedule C on your tax returns, then I think, that's a reasonable standard to use this for PPP. I think if this is something, where there are IRS guidelines around what counts as a home office, and I think if you are within those and something you typically count as a business expense, then yes, by all means do so. If you haven't done this previously and you're just saying, okay, I'm working at home, but just generally in my house, I've never done a home office, deduction, then I would say you're on a little less certain ground there, and I would hesitate to say you should do so. Again, that's just my interpretation. I think following IRS guidelines on what constitutes a home office is probably a safe way to go.
And Seth, we actually have a question here from somebody who received an EIDL loan. Is the deduction only the $10,000 grant portion? In this case, they were approved for the full loan and for PPP and are using them for two different things. How does that work with forgiveness?
Yeah, that's a great question. So the way it works, which isn't very well worded by the SBA, is that if you got an EIDL loan between January 31st and April 3rd of this year, and you're using that EIDL for payroll, and then you subsequently got a Paycheck Protection Program loan, which you're using for payroll, then you need to refinance the EIDL using the PPP loan. Now, the way that would work is that you would refinance the EIDL amount minus the amount of the advance that you received, right? Because that advance is a grant. It's not a loan, so it doesn't need to be repaid. So you just deduct that out of what needs to be refinanced. So to just put a finer point on that in an example, if let's say you got 100,000 EIDL and that included a $10,000 advance, and you haven't made any payments of the EIDL yet because it's deferred, then your balance is 90,000. And if you're using that for payroll, and then you get a PPP loan that you're using for payroll, you'd need to refi that 90,000 into a Paycheck Protection Program loan.
Wonderful, thank you. For Justin, for somebody who received their PPP loan on May 4th and the first payroll period after the loan received was May 15th, can the 8 weeks start with the May 15th payroll?
Yes, so I'm assuming if you have a May 15th payroll, you're paying twice a month. Assuming that is the case, then there is that provision for the alternate payroll covered period, which then you could, yeah, if you got it on the 4th and your next payroll is 15th, you can opt to start on the 15th.
Wonderful. There are some more questions around what counts for sole proprietors here as potential forgivable expenses. This person asks about 3 expenses. One is attorney's fees, second is accounting fees, and third are annual contracts, such as marketing and advertising.
Yeah, pretty clearly all of those are not eligible for forgiveness. Again, just as a reminder, the only items that are eligible for forgiveness are payroll costs, which consist of cash comp and some other benefits like retirement and healthcare contributions made by the employer, plus state and local taxes paid by the employer, such as a state unemployment tax. Then you have the non-payroll eligible items, which are mortgage interest, rent obligations or lease obligations, and utility payments. And anything outside of that is pretty much, not pretty much, but is categorically not allowed.
Justin, you actually bring up a good point that hits on a handful of questions we have, and I'm finding we tend to get with each of these, which is what counts as a utility. Can you walk through what we know of as today counts towards utilities?
Sure. Let me just find the slide. Okay, so here we go. So right now, utilities, I'm going to use the pointer here, are these items here. Don't have any more detail than what is listed here. I think electricity is pretty self-explanatory. Gas as well, water as well. I think the last 3 are where there can be some level of interpretation. Transportation, it's not quite clear what that would be to me. Or all the different use cases. Telephone, I think if you have a physical building with a landline in your office, I think that would certainly count. I think if you have business cell phones that are paid for by the business and used by your employees for business purposes, I think that would count. And then internet access, I think, in a place of business, or, in the case that maybe you are reimbursing employees for internet, if maybe you've gone fully distributed or something like that, or anything, where the business has to be paying for these things. This can't be, I operate my own, I'm paying for my own cell phone plan even though I run a company, unless this is something that you always expense. I think it's kind of the border between new stuff and stuff that you're already expensing and deducting for your taxes. But business purpose being kind of the key point here. It has to be what you're using it for. In terms of what all the different types of utilities that fall under these categories, we haven't received any finer guidance in this.
Right. And another question for you, Justin, that's a pretty popular sentiment we see on these. In this particular case, this person wasn't able to rebuild their team and match headcount right at the point the loan was deposited. They are bringing back their team today, but they received the loan 2 weeks ago. How does the grace period work there?
Yeah. So the way it works is, there are 2 potential reductions you can get to your forgiveness. Even if you were able to spend, 75% or 100% on payroll and the rest on, forgivable non-payroll, you get to that amount, it gets to 100%. Even if you have that, there's 2 ways your forgiveness could be reduced. And one is based on what the SBA defines as full-time equivalence, which is essentially, employees working 40 hours a week. What you do is you essentially compare, what you have during the covered period against, one of a few reference points that you can use. One, you can compare that number of full-time equivalent employees from, the covered period to the first 2 months of 2020, or you can compare from basically February to June 2019, use that as your reference period for average FTEs. And if you're a seasonal business, there's a bit more flexibility as well. And I encourage you to read the fine print. But so what this means is if, you brought in this example, if you brought your team down, from, say you had 10 employees on average under this full-time equivalent standard in January, February of 2020, then you went down to 6 employees. And now you're wondering when you would have to bring those back by to achieve, to not run into that forgiveness reduction. And the answer as of right now is June 29th, 2020, meaning you don't have to have have to achieve an average of that 10 employees that you averaged before during the covered period, but you do have to get back up to that number by the end of that safe harbor date, which is currently June 30th. Now, obviously, if these changes pass, that will be pushed back out, many months potentially, and you'd have far more time to kind of meet this guideline. It's kind of the same concept for if you've reduced your hourly rates or salaries of your employees. That looks back at the first quarter of 2020 and compares to where your employees are at the end of this kind of safe harbor period, which is again ending on 6/30. That's if you brought everyone down by 30% all across the board and then only raise them back up to the same rate on June 15th, you would still not be impacted in it, as the safe harbor would apply to you in that case. So right now it's just you have to get back to the previous level that you're being compared against by June 30th. But again, it seems likely that date is going to get pushed back next week if the Senate approves a plan like the House is.
Great. Justin, for you, are all employer-related taxes are they in respect to payroll forgiven, or able to be forgiven, I should say?
So the answer to that is no. No, mostly. So when you're looking at what's included in the forgiveness amount, it's the same as when you were looking at what was kind of your average payroll number for calculating your actual PPP loan amount, is that you're looking at gross pay. And gross pay is before, you have the deductions for employer and, employee paid income taxes on the federal and state level. And those and other payroll taxes, like I guess, Social Security, Medicare, and so on and so forth, those aren't included in the taxes that can be forgiven. The only taxes that can be included in the forgiveness amounts are employer paid state and local taxes. So these are generally 95% of the time for people will be things like a, Colorado state unemployment insurance tax, or the, Illinois state unemployment fund tax. And, these are pretty common, in most states, and those are kind of the only things. Another one, maybe if you're in the New York metro area, is the transportation tax. There's a few like that, but mostly you can kind of forget that payroll taxes and other taxes are included in this.
Right. And you offered a pretty detailed explanation earlier, but I just want to clarify for this person. If we lay off one employee but hire a new employee, 1-for-1, is a PPP loan still forgivable?
Yes, I mean it's always going to be forgivable. This would reduce, if you didn't hire that person back, it might reduce your forgiveness amount slightly. But if you don't need to have the same employee hired back. It's all about numbers. So if you had 10 employees, one was let go and you rehired another one, it's just as good, and your forgiveness wouldn't be impacted as long as that happened by June 30th as it stands now.
Right. And does paying the owner of the company count towards the 75% they must spend on payroll for the PPP loan?
Yeah, so this, yes, is the short answer, especially, if you're a sole proprietor and, this was, you were basing this off Schedule C or 1099s for your income for the loan itself, then most definitely that would count. When you get into, owner draws and things of that nature, again, if these were, part of the basis for calculating, your PPP loan, it's safe to assume that, these can be included as well, but you have to be careful about the $100,000 cap on, what can be included. There are some, corporate situations, C Corps and other things that I hesitate to give guidance on. It's a little more complicated, and I don't want to dive too much into it, but generally speaking, and especially if you used your that income as the basis for your loan, then you should be able to use that as part of your forgiveness amount.
Great. So another popular question we get that's worth revisiting is, for those who are sole proprietors, their loan was based off their Schedule C, line 31. They're essentially getting checks from other people deposited directly into their bank account. How do they prove that they use the funds for payroll costs?
I didn't hear the middle part of that. Can you say it again, Meredith?
Yeah.
Sorry.
So for sole proprietors that are getting, let's say, paid directly into their personal or business checking account from customers, how are they, and are paying themselves that way, how are they proving that they use the loan, which also was just deposited in that same bank account for payroll purposes?
Yeah, so this is one we've gotten a lot, and I think there's no explicit guidelines from the SBA on what you should do here, but the guidance is that you will have to prove it in some way at the end of the period. So if you're in the case where you're a sole prop and you receive your income into your normal personal checking account or whatever, I think there's a few steps that you can kind of take to maybe set yourself up to have more of a record. You could create another account, basically another checking account or duplicate, name it something like PPP or whatever, and put the funds that you receive from your loan into that account. You could then pay yourself kind of then back to your main account as like, hey, this is my payroll. And then if you're paying something like rent, you could also pay it out of that account. And that way the debits that are coming out of that account are all PPP related. That's one strategy. And maybe people have already been kind of spending some of this money, so that might not be super clean at this point. But you could also, even if you're a sole prop, you're filing taxes at the end of the year, and you're having to keep records of each month, whether you keep, your records in QuickBooks or Xero or just, in Excel. You still need to have some sort of record of what revenue and expenses you have. And, as long as you can probably produce a clean, what looks like an accounting system file that shows, hey, these are my expenses for this month, including payroll to myself. This was the loan proceeds received. That hopefully should suffice. But basically, if you don't have a way if you don't have a paper trail naturally, you're going to have to create one somehow and create a record of this money. Because I do think if you try to get to that point where you're trying to get this forgiven and you just have it all in one bank account and no record of any no piece of paper or digital piece of paper showing that money as your income, then I think that'll be difficult for you to get that forgiven. Great.
Seth, going to kick it to you for two questions. One is a clarification on something said earlier. So that the EIDL loan will be deducted from the forgiveness amounts. Are you referring to only the $10K or the whole amount of the actual non-advance EIDL loan received?
Yeah, so just to reiterate, the EIDL loan can impact your overall PPP loan amount that you receive when you go to apply for the PPP loan. So the way it works is, again, if you receive the EIDL loan between January 31st and April 3rd, and you're using the EIDL for payroll, then you must refinance that amount less any advance into the PPP loan. So again, if you got, call it $100,000 EIDL and 90,000 of which was loan, 10,000 of which was advance, then you would reduce that 100,000 by the advance amount. So 100 less 10 would be 90, and that's the amount that you would need to refi into the EIDL. And that impacts your overall, into the PPP, and that impacts your overall PPP loan amount. Justin, as far as the forgiveness piece goes, my understanding is just the normal forgiveness protocol would follow because the loan has already been accounted, the EIDL advance and loan has already been accounted for in the PPP loan amount in that situation.
Yeah, that's the way I understand it too.
And a follow-up question for you, Seth. We have somebody who is an S corporation that's only paid through a K-1, and they've had trouble securing a PPP loan because they don't have any of the traditional information such as a Schedule C or a 941 or W-3. So is there any way they can get a PPP loan, or are they not eligible?
So you can apply with, if you're an S Corp, your 1120S and the K-1 showing the income that you are paid. If you file an 1120S though, you should also have a 941. So it's a little confusing there based on the question. And then I believe the question is from someone who's technically an independent contractor. And if that's the case, then you should also have 1099 MISC forms, as well as I would expect that your income would show up on a 1040 Schedule C, 1040 being your personal tax return, Schedule C showing what you would make as an independent contractor on line 31. Mm-hmm. So a few different options there, but I would recommend collecting all of that information and documents and work with your accountant if you have one to be able to pull those documents together and apply.
Great. So, sorry, 1 second. My computer just started to crash. Going back to clarifying something that you said earlier, Justin, in this person's PPP app, it showed the number of employees paid rather than the full-time equivalent. Do we need to fix that, or will it be an issue in the forgiveness phase? You may be on mute, Justin.
Yep, sorry about that again. Can you repeat that one more time? I'm not sure if I understood what it was trying to say.
So for this individual, on their PPP application, they inputted the number of employees that were paid rather than the full-time equivalent. Do we need to fix that, or will it be an issue in the forgiveness phase? So my guess is they probably included some part-time in there.
It won't matter as much what you put on the application. It matters essentially, you have a choice of 2 reference periods to look back, and you'll have to calculate your full-time equivalent employees based on those periods, just based on your records. So, you can kind of, I guess, disregard what was specifically on your application and say, okay, you can either look at January 1st, 2020 through February 29th, 2020, or February through June 2019. Either of those can be kind of your reference period. And there are instructions in the application about how to calculate, your full-time equivalent employees. There's a simplified way and a more detailed way. But you shouldn't, the mix of those, obviously could change. And I think that's the kind of the point of these, the simplified calculations and doing this on an equivalency basis and not a just pure numbers basis. And it's also, if you think you might have messed up and put too high or something or too low on the application, this should allow you to kind of make up for that.
Yeah. Clarification around the payroll amount. Is it gross salary or net?
Gross.
If the 8 weeks is extended to 24 weeks, may we use more than 8 weeks of payroll?
Well, to interpret that, to ask it if you get a bigger loan, and I don't think that's what they're saying. No, you can't spend more than your loan and get it forgiven. However, if the loan itself was predicated upon this 2.5 times average monthly payroll, which was designed to be, it was designed to be this 3/4 of the total, whereas 75% for payroll, and you could have 25% for other things. However, you could spend 100% of it on payroll, and I think so that 8 weeks, if it was stretched to 24, your dollar amount of the loan wouldn't go up, but you would have an opportunity to spend a higher percentage on payroll, most likely. My take on the 24 weeks is it would allow probably the vast majority of people to get the whole thing forgiven based on payroll alone, because you're tripling the amount of time you have to pay out these payroll costs. Meaning, if you had kind of got your loan off of 2 months of payroll, or 2.5 times average monthly payroll, you have 24 weeks to use that. Then you're in a much better situation for being able to deploy it. It's not going to cover your full payrolls probably at that point, but you should be able to kind of max out that usage on payroll, if that makes sense.
Mm-hmm. Definitely. Awesome. So we are just up on time. Thank you, Justin and Seth. That was some really helpful information, and it sounds like we potentially have some exciting news ahead of us. So for those that have joined us this week, I do hope you are able to join us next week, Tuesday and Thursday at 1 p.m. Eastern. So we may have some information to report out on depending on what happens in the Senate. But regardless, we are very thankful that you've joined us, and we're happy to be helpful during a time with something like the Paycheck Protection Program, which we know is very complex and requires a lot of input on your own end to understand and ensure you're doing the right things. If you have any questions, you can find each of us on Twitter as well as Fundera on Twitter, and you're welcome to email support@fundera.com. We're happy to help. Also keep an eye out. Following, we'll send the recording as well as the slides and information on the new webinar series we have on the 7A loans. I hope everybody has a wonderful weekend, and thank you again to Justin and Seth.